Welcome to another inspiring edition of the Brandi Jo Show, your weekly dose of wealth and wisdom for a prosperous financial life. And here's your host, Brandi Jo Newman.
Yes, exactly.
All right. So let's jump in with, and let me backtrack a little. Earlier this morning, I was talking with a potential client about buying her first rental. And, you know, my question always is, what are we doing that for? Is it just about the money? Is it about the ownership? Is it about, building wealth? Because buying a full-blown home and then trying to find somebody to help you pay for it can be daunting if you don't have a lot of liquidity. It does, but we talked about all of the other things. And so I have on my phone, I just have a list of, if it's just about income, if it's just about a secondary income and a tertiary income, and then having that domino effect of multiple sources of income, this is the list. And note buying and then tax liens are on that list. And they're like sitting there going, wow, there's a lot more ways to make money than just rentals or real estate or private mortgages.
Yeah.
So let's jump in and let's give the people, our fellow humans, the nitty gritty of how to start with note buying, just right off the top.
Okay. I started out, as many investors do, with building a rental portfolio. I'm based in Philadelphia. I started buying and building a rental portfolio of single family homes, some multi-unit buildings. And my whole goal, my objective was cash flow. That's what I wanted. I wanted to diversify my income source from my paycheck from my engineering job that I was doing, working as a computer engineer. And so I did really well with that. It was about 20 years ago. And after some amount of time, I started to see that, this is good, but it gets difficult to scale. You maybe you have one or two houses and then 4 or 5, but then how many properties can you own and manage and still maintain your sanity, your quantity of life? Mm-hmm. And I was involved in real estate, my local real estate investment association, RIA groups. They're all over the country. I recommend those highly for anyone interested in real estate investing. And I met some people, they owned 50 houses, they owned 100 houses, big portfolios, and they had to have a whole team, employees and a team to manage it. And it's just a lot of moving parts. And so around that same time, through my real estate education, I started learning about note investing and meeting people that were doing private lending, private mortgages. They were the ones that were more seasoned investors, where they were doing less and less of these fix and flip properties, and they were using the capital they had to lend to other investors so they could do their deals. And I saw that trend, and I ended up learning about note investing through the education opportunities. And finally, I met a couple of individuals that had mortgage notes to sell. And these were institutionally originated, bank originated loans that were bought and sold on the secondary market. And so when I encountered that, I knew exactly what it was, because I had already previously learned about note investing. And I became very interested because I saw it as a way to diversify from my real estate holdings And I saw and recognized that it was something that you could really scale and grow into something big and ramp up a portfolio. The most successful note investors, they've been able to ramp up to portfolios of hundreds of notes or thousands of notes. There's some successful note funds that, they have large portfolios like that. And it's the industry setup that makes it easy. And so that was very appealing to me. But what I really liked about note investing was that you could buy notes at a discount. In other words, you could buy them for less than the amount of the loan balance, which is something all of us as real estate investors, we want to buy at a discount. The second aspect was that you're investing in something that's secured and backed by collateral, and that gives you downside protection on your investment. And the third is that you could earn a high rate of return. And so when I saw all those three aspects, I became very interested. And over the years, I've transitioned my focus, my investing in my business to focus on the asset class of mortgage note investing.
So in essence, you've become the bank, and we
Exactly.
all know that the bank, they're the ones, they're like the house when you're gambling. They're the ones that are always going to make money. So you've transitioned into being the fulcrum into not just the liquidity and then the rate of return. You've basically brought other people along by being the bank to other people so they can get their dreams paid for.
Yes.
So you live you're in Philadelphia, correct?
Yes.
Have you ever ventured outside just with your actual real estate that you do have some left, correct?
Yes.
Okay. Are you just in Philadelphia or are you in other markets as well?
No, I've invested in other markets, invested in larger syndication deals, apartment deals around the country. And so this is where I invest as a limited partner in these
Gotcha.
larger syndications where there is a local team with management and operational excellence that they run the property. And
Okay.
so I've expanded, but this is an interesting point, Brandi Jo, with note investing. It's not that I'm buying notes on properties in my local area, not at all. We buy nationwide,
Right.
all over. And so it really opens up a lot of possibilities. You have geographic diversification. The investments are spread out over multiple real estate markets because, as we know, real estate is all dependent on your local market. And so that's a really nice way to diversify geographically.
Yeah. With that being said, does the average everyday American, so like 57%, I read an article the other day, 57% of Americans, working age Americans, cannot get their hands on $1,000 in an emergency. So with
Let's talk
that
about
amount of, just awful financial literacy, and can the average person start with $10,000, $20,000?
Yes.
And then is there management in that particular note?
Yes, absolutely. That's a great question. And I'll talk about this. Notes come in all sizes. I've seen loans that have a $4,000 or $5,000 loan balance, and that goes all the way up to jumbo loan territory where you're $1 million plus on the loan balance. and everything in between. And so
So,
there's no limit. You can find what works for you.
yeah.
And as far as the management, absolutely. Let's talk about management. This is a very important detail in the space of note investing. There are note servicing companies that exist. Note servicing company, what is that? A note servicer, they manage the note. In other words, they collect the borrower's payments. They keep track of the amortization schedule. They answer phone calls from the borrowers. They prepare the tax documents that have to go out at the end of the year, showing how much interest you've paid, all of these things. If a property is going to be sold or refinanced, it's the servicing company that handles preparing the payoff quote, coordinating everything with the title or the escrow company for the closing. They do all of that.
Will a note
And
transfer sometimes on a piece of property?
yeah, absolutely. It happens every day. Absolutely. When we buy notes, we buy bank originated notes. And so they're bought on the secondary market. Some other bank or lending institution created them and originated them and then sold it afterwards. And most people have experienced that loan. They get a loan and then it gets sold and transferred.
Okay.
And so that's the space we're in. We don't, a different business model is where you create the note. Maybe you're doing an owner financing transaction and create the note, but we focus on buying notes that exist already. There's no right or wrong answer. It's just a little bit of a different business model. That's all. And so, yes, notes transfer, the ownership is transferred, and then it gets documented on title on the public record in the county courthouse where the mortgage is. And so everything's documented, recorded, and that's how you're protected on title as a secured lien holder when you own a note.
And then to secure that note, it's all real estate, or are there some personal notes too, or like some business notes?
There are.
Like
Yeah, there's notes on
like
many
a
different.
note or something like that?
Yeah, absolutely. I focus on residential mortgage notes, but there's notes on commercial properties, industrial properties. There's notes on vehicles, right? Car loans, those are notes. They're secured by the title of the vehicle. There's aviation notes. There's notes on yachts and different watercraft. There's also unsecured notes, things like credit card loans and personal loans where they're unsecured. There's no collateral behind them. So there's all these different types for sure.
Let's talk about commercial real estate for a minute, because, there's something happening in the commercial real estate world. Before COVID, 6% of the national workforce was considered work from home or a hybrid. Now I want to say it's upwards of almost 50% that are a hybrid, 26% literally truly work from home. And so there's no need for office space. And, you see some of these, high employee corporations that are saying you have to come back into the office.
Mm-hmm.
And you see some people that are saying, no, I'm not going to come back into the office, and I'm going to go get another job that's going to let me basically live my life the way that I want to live it and still do the things that I'm good at.
Exactly. That has been a big shift that came about during the pandemic, for sure. The bottom line, Brandi Jo, is that overall, employers are ending up to need less space than they used to occupy in the past. And this is what's happening with commercial real estate. So maybe they're downsizing. Maybe a company occupies 10 floors of an office building, and when their lease comes up for renewal, maybe they find, well, we only need 6 floors or 5 floors or whatever, a smaller percentage. And so they're reducing their square footage requirements, or maybe moving completely out of a property and into a smaller location. And so this is happening. And there's definitely some interesting activities happening in the marketplace. We're hearing about different investors getting creative where they're repurposing property. Maybe it was a retail big box facility and it's being turned into some type of an entertainment venue, or turned into self-storage, or a commercial property, office buildings getting refurbished into apartments, especially if you have one of those classic industrial properties with a lot of character. They're getting turned into some really nice loft apartments with exposed beams and exposed brick walls and some different details that make them appealing. And so these are some of the opportunities for developers and investors where they can come in with a vision and repurpose a property that maybe wouldn't be doing well as a commercial in their prior type of service, and now it's being changed to a new use that's profitable.
That takes so much capital, though, now at interest rates that are what, 3,000% higher than 1-2% interest rates. I read I think it's MSCI or MCSI, I can't remember the acronym. 50% of the loans that originated in 2013 and 2014 in the commercial real estate from national banks and regional banks are underperforming. 50% of those loans. And the majority of them come due in 2024.
Yeah.
There's like almost $3 trillion worth of commercial loans that are going to come due between 2024 and 2029. And half of them today, and when you say underperforming, in other words, they're not being paid. They are behind on their payments.
Yeah, or they may be being paid, but they've matured.
Yes.
Because those might be 5-year loans. And so they're matured. They've matured, and the borrower is still making payments, but everyone's sitting there saying, okay, now what do we do? Yeah. Do they reset the loan into today's interest rates, and which is much higher? Or did the value of the property go down and now there's an issue with loan to value that has to be resolved? Absolutely, that is creating some unique circumstances. And
where's the opportunity in that, though? Because, the talking heads on the CNBCs and even some of the financial influencers on social media, all they're doing is saying, this is what is happening. Just like what I just did. All I just did was tell people facts of what is happening. Where's the opportunity? Is the opportunity to go creative, like you just mentioned, and went into great detail, or is it let it fail and see what happens?
I have
as we all know, the government, the Treasury, the Fed, they're not going to let these commercial properties go under. They're not going to let these banks fail. They may let the regional banks fail.
Yeah, there could be multiple different outcomes. It could be like we saw in the 80s, where commercial properties are getting taken over and liquidated and sold at huge discount. Mm-hmm. Well, that creates opportunities for investors. I know some old-time investors that during that era of the 1980s and the Resolution Trust Corp and all that, they acquired commercial properties. They acquired commercial loans that were in trouble. And so it remains to be seen. It's quite interesting. We see sometimes the government steps in, does a bailout. Sometimes they don't. So there's no guarantee on that,
Right.
but this is something that's playing out in markets all over the country. I just saw in my area a commercial building that was a one-story complex, right? One-story office building. It was vacant for a while. Well, I just saw the building got demolished. The property was sold. Developer bought the property, demolished the building. Didn't seem like there was anything wrong with it, but now they're constructing a 4-story self-storage facility. And so it's a change of use.
Yeah.
And they're taking on a lot of expense building new. And that's what they're doing. And so they've had a vision and are implementing that. And so we'll see different scenarios play out for sure. And it's very difficult to tell how it's going to go because of so many different forces. And is the government stepping in any way and changing things and pulling levers? It may happen. How do banks respond? What are banks doing when they have assets that are in default, and it's a lot of them?
Right.
Most banks, we know how banks are regulated. They have a lot of pressure to get distressed assets off the books as quickly as possible, whether that's selling the loans outright or taking possession of the property and then liquidating it. That's never changed. And so it's going to depend highly on the regulatory environment moving forward.
Let's take your example of a piece of property. How many acres do you think that single-story commercial building was? How many acres? How much space?
Less than 1 acre,
Okay,
maybe
so let's-
3/4 of an acre. Yeah.
Okay, so let's just call it an acre, and they're going to build a live storage or public storage or something like that.
Yeah.
That goes from 1 story to 4. That's basically, it's 1,000% more space. And then in order to do that, you have to be financeable.
Absolutely.
Everybody
And
knows
liquid.
storage. Well, and that's what I was going to get to. The liquidity that you have to have. And that's also, you can call it a bargaining chip, but you can also call it positioning. Is we have had this incredible run up in the market just this quarter alone, or this quarter and a half, of 22%, only in very specific pickers in stock, mostly tech. I'm a big believer that you need to harvest gains as you go along. That gives you liquidity to actually diversify into other areas. And so when I'm sitting down and I'm talking to a client, when I'm talking about diversification, I'm not just talking about diversification between stocks and bonds. I'm talking about true diversification in their entire personal economy.
Yeah, absolutely.
Financial life.
I couldn't agree with you more.
And it's to have that example, that person, let's just say they have a fund, or they have limited partners. They have a fund, they have partners, they get to, they call the shots, they get to do whatever they want to do, and then they finance the rest of the deal. So they're basically self-financing their equity, and then they're financing the actual build out and the construction. There are so many more places to find money these days that, again, the average American worker doesn't realize that are out there. There are capital groups, there are lenders that have their own private money. And it's all about the idea, and then the facts. Are you financeable or not?
Yeah.
Do you find that, well, let me ask you, are you heavy in reserves? Or do you always have at least 3 to 6 months of reserves, just in your note buying business, not you personally, but just having those reserves? And then when you calculate your return on investment, do you have a side fund to where you just take a little bit of your income, your revenue from your notes, and you set it aside? Because in my opinion, your money is your inventory. And
It
then
is,
that
yeah.
inventory, you're going to go out and you're going to sell that inventory to someone else.
That's correct.
Hoping that you get some sort of percentage rate of return on those products, which are those dollars.
Yeah,
Right?
absolutely. Here's what happens with a note portfolio, Brandi Jo.
Okay.
You're receiving payments every month,
Mhm.
right, on the notes. Those payments consist of interest and a smaller portion of principal. You're getting your principal back each month, portion of it. And so that's money coming in. Consider also this: the average lifespan of a residential mortgage note in the United States is 5 to 7 years. Even though it might be a 20 or a 30-year term, on average, 5 to 7 years is where a property gets refinanced or it gets sold, because life happens, right? People need to move into a larger home, or they want to get into a better school district, or they're moving to Texas because of a great job opportunity and all the growth that's happening there, right? I'm sure you have lots of new neighbors every week,
Yes.
right? I know it.
500 people a day are moving to the Golden Triangle, which is Dallas, Houston, San Antonio.
Yeah. And
That's
so,
like
yeah,
100.
it's happening in a large rate. And so all of this activity results in loans being paid off. And for the note investor, the lender, you never know when it's going to happen. It is an element of randomness in our business. And our job, managing a portfolio, is we take all that capital and we have to redeploy it. We have to invest it into new assets, buying new notes. And so this is an ongoing part of the business, is having access to notes and being able to redeploy your capital. Because if you're sitting on idle capital, yeah, you need reserves. That's certainly a good business practice, but you don't want too much, because that cash is earning you zero rate of return. And so that's something to be mindful about. But it's a delicate balance when managing a portfolio, is being able to redeploy that capital on an ongoing basis.
Mhm. Well, if you look back at your portfolio of just your notes, is it 7 to 10 years? Because it's funny that you actually mentioned that. I was talking with someone this morning about that you're not going to own a rental forever. You're going to try to harvest the equity in that rental through refi. And then as the market expands, you're going to want to get into probably bigger and better, more sustainable markets. And they didn't see that. And so, so that's why they're talking to me, in order to, expand their vision of what their business model should be.
Yeah, those are great conversations to have.
So I'm trying to find backup for my insight. In your note portfolio, is it 7 to 10 years that you're seeing that turnover? And do you sit down and then do you see, like, when the notes are coming due? Do you have that on like a calendar, on a schedule?
Well, you see that. I mean, we have access to run reports from the loan servicer that shows all of that, and also the internal systems. But again, you never know when it's going to happen.
Yeah.
It's
Yeah.
it's not something that you can predict. I will say that during the past 3 or 4 years, when interest rates were record lows, a lot of people were refinancing.
Mhm.
A lot.
Yeah.
That's why mortgage brokers were going bonkers. Of its volume is huge.
Mhm.
That has all subsided now, because now today, everyone that could refinance into a better rate, a better mortgage, they have already. And
Yeah.
so what a lot of that volume went down. Mortgage originators have scaled back on their volume and employees and size. And the transactions that are happening now are the purchases, the people buying a property.
Yeah.
And so I can envision that the refinance is a lot less. And so it's going to, the pendulum has shifted the other way for the time being.
So like with anything, note holding, because you go from note buyer to note holder. Note holding, buying is all cyclical, really depending on interest rates. Is that kind of the first cog in the wheel?
It's one of them, but there's many. It's liquidity. If there are liquidity crunches in the market, especially at higher levels, that results in assets getting sold. And then all of a sudden, a lot of notes get released to be sold on the secondary market.
Is that right
And
now though? Or aren't we in kind of a liquidity
it's happening
crisis?
now. Yeah.
Okay.
Yeah. We're seeing it now. And so that creates opportunity for investors. And so this is part of the standard movements of markets. And so at every level, there's a different type of focus, a different type of activity. So we buy a lot of loans from hedge funds, from larger note funds that they're selling off part of their portfolio, or maybe this happens at the end, last quarter of every year. Funds need to close out a portfolio. So
Yeah.
they basically go and sell off all the remaining notes just to clear books, clear everything out, recoup their capital, and then they pay back all their investors. And so you see some of these different forces at work, and it creates opportunities. And if you are a savvy note investor and you're positioned to take advantage of opportunities like this, then that's great. You can do really well.
So it always comes down to liquidity.
Yeah.
And liquidity comes in two, well, really three forms. You can have it. You can literally just have it sitting around. You can have cash sitting around. We hold most of our liquidity, most of our capital. We hold most of ours in cash value life insurance. So it is generating dividends, interest, along with the death benefit.
Yes.
The other way is to basically go and find the liquidity, because someone is so financeable that they can go to like a local regional bank, and they can already be successful in one area of their life in terms of either a business or their profession, and have the money, have the income for the bank to say, okay, we'll take a chance on you building your own, storage facility or ER clinic or something like that. And that is another form of liquidity, that someone gives you the liquidity, but it does cost you. When someone's sitting around and they know that they're squandering their time with working and making a paycheck, let's talk about somebody that's sitting around and they have $10,000 to, they don't have only $10,000, but they say, okay, I'm going to take $10,000 and I'm going to generate a second income. Not necessarily a side hustle. This needs to be truly passive.
Mm-hmm.
Do they need to invest in themselves first with, joining some of these associations, joining some of these private note buying groups? Is that the better way to go? Or should they just jump in and go to a note buying website and clicking on one and throwing some money at it.
Yeah,
Well,
that's a
they
great
should read
point.
your book, right?
I
First, read your book.
yeah, I advocate get some education, get some guidance. Yes, you can go off and find some website and go buy notes, but you can also lose a lot of money very quickly if you don't know what you're buying, you don't know how to perform due diligence. So education is definitely important.
I'm a big proponent of finding a mentor
Yeah,
in whatever that you are interested in, not something that you necessarily want to do, because you may find out that you really don't want to do that.
yes.
Um,
We can talk about that with note investing, right?
okay.
There's two ways to invest in notes. You can go out on your own and buy notes and build a portfolio, right? That's the active investing approach. And there's also the passive investing approach where you can invest in a note fund. And what a note fund is that there is a team, the fund manager and their team, they raise capital from investors, and then they'll go out and buy notes. They have the expertise, the experience to evaluate notes. They have the relationships in place to buy them and have access to them, and then pay out a cash flow to the investors. So for the investors, it's passive income in the true sense. And for an investor, that may be a busy professional, or they are an entrepreneur and business owner, and they're focusing on their work and their business. This is a great option for them. Great option. There's no right or wrong answer about this. If you're interested to be active and you have the time and energy to dedicate to it, great. But definitely get educated, get a mentor, as you said, super important. But this is something that there's no right or wrong answer. It's a very personal decision, and spend some time thinking about it and exploring some different options.
Do you have a fund?
I run a fund, yes.
You run a fund. Okay. Is that fund owned by a holding company?
Funds have many different structures, Brandi Jo.
Yeah.
There's the typically they're registered with the SEC and set up under different configurations. So you'll find all many different configurations. Some funds only accept accredited investors. Other funds are open to both accredited and non-accredited. And so there's a lot of different configurations out
Yeah.
there.
Is it a 506 CB something, right?
Those are, there's 506B, 506C, there's Reg A. Yeah, that's a whole world of different offerings and options for sure. But what I always tell people, if you're considering a fund, a note fund, spend time on your due diligence. Of your due diligence of on the fund managers, on the team, what's their track record, get some references,
Yeah.
check them out. What's their status with the SEC? These are all very important steps to look at, because
Well, you mentioned that fund managers don't necessarily own the fund. And so when we're sitting around with a client that's got, X amount of dollars that they need to move and they need to put someplace,
Yeah.
looking at, the Morningstar reports and all of that with mutual fund managers, it was usually the manager that made the difference in the fund. And then, well, look at this track record. Well, that manager is no longer there. And so you would find people throwing money into a mutual fund and then having it just, squander around, barely head above the water. And it's
Yeah.
because the manager was, scooped up and they went to somewhere else. So that is part of the diligence that people need to take on, but they also need to have the ability and the flexibility to keep moving that money around. With your book, is because I get into a little bit of the questioning in my due diligence of managers of funds, because if I hear about a manager before I hear about the fund, I'm like, okay, what are we doing here? Why are they sharing their insight? Is it marketing for the fund? Do they really have a good track record? Are they actually going to, share those things up front with the public? I always think that there's a disconnect between the average American, somebody who just went to school, worked hard, got a degree, got a job. They're making way more money than their parents did. They think they're ahead of the curve, but they don't see wealth. You know what I mean? And then they think that their wealth is going to be accumulated and grow exponentially by throwing it into the market or throwing it into funds, when in my belief and my philosophy is that you have to put your money to work where it actually creates more money, to where that money actually flows back to you.
Yes.
So when we're sitting around and we're talking about, where to put money and what is going to be the biggest bang for the buck with the least amount of risk, I like to go with, cash flowing funds.
Right. And that's a preference, Brandi Jo, there are funds that pay out with different structures. There are some, they'll pay out cash flow monthly. I've seen others that pay out quarterly. I've seen other funds that don't pay any cash flow out and defer everything to the end. Maybe they have they're a 3-year fund or a 5-year fund. Everything gets deferred to the end. There's just different business models. So for you as an investor, do you need that money now?
Right.
Or are you 20 years off from retirement? You're investing with retirement account funds and you're willing to wait to get paid, maybe in exchange for a higher rate of return, and that's okay. It just all depends on each individual's needs.
Right.
And you'll see all of these different configurations. So when speaking with a fund manager, these are the conversations to have and the questions to ask to make sure, is this a good fit? Is the timeline in alignment with what you need, right? Are you investing in a 12-month type fund, or is it multiple years? There's all the different configurations are out there, and it's a matter of exploring options and seeing what opportunities are out there for you in the marketplace.
Open to talk with investors of all kinds?
Absolutely. I love speaking with investors,
right.
And I take the approach.
Sorry.
Yeah.
The reason I asked that question is because most people, and now we're going to get into the emotion of money a little bit.
Yeah.
Most people that I talk to, when they call me or they text me or they email me, can I ask you about this? Of course. And it's usually something that they've been thinking about for months or years. It's, why did you wait so long to ask me? I didn't think you would waste your time with me. And I'm a fund manager. I'm just your everyday, simple financial planner. Now, I'll do some outside the box, against the grain planning. I'm not your typical financial planner. But that whole self-worth of, like somebody yesterday said, I don't have a lot, but it's like around, $850,000. And I go,
Yeah, it's a relative thing, isn't it? But back to your question, Brandi Jo, absolutely. I love speaking with investors, networking and building relationships. Even if we never do anything together, that's okay. Like I'll go to investor conferences, I'll talk to hundreds of people. That's okay. And people always approach me about education, about learning. And yeah, I have my book that I wrote. It's a low cost item. You can learn a lot about note investing by reading books. There's different courses that exist out there that people can take advantage of. Sometimes people looking for different things, but absolutely having a conversation, asking a couple of basic questions all the time. This is part of the daily work. I seek to bring value to others. And if I can't help you, I probably know someone that can, and I'm happy to make an introduction. And that's totally okay. And it's really comes from what you said about the energy of contribution, the energy of adding value to others and bringing value to the marketplace. I feel very strongly about that.
Is that why you wrote the book? Is
It,
that, it's a low cost entry to, finding out, as much as you want to about a certain topic? I find that when I share my stuff on Instagram, on LinkedIn, our podcast on YouTube, my little courses on YouTube, many people are, well, there's one of two reactions. There's one where I'm going to try that. I'm going to call her and I'm going to ask her, does this fit for me? And then the other part is the other reaction is usually from industry people, stop sharing that stuff because that's how we get paid. And I find it, there's this disconnect between, obviously there's a disconnect between the very wealthy and the very poor. There's a huge divide there, and it's mostly about information and education.
Yeah.
And the other divide is, people that are wanting to find out the information, that are wanting to get educated, and then they're turned away by the institutions or the brand names because they're
transactional.
Right. They're completely transactional.
Yeah.
So, well, I'm glad there's people like you and me that are putting it out there, because the thing about it is, and I don't know where I got this. One of the things that I try to do is I try to help 1,000 people a day. And
Wow.
That's where I get my social media metrics from. So if I have 1,000 people, TikTok, LinkedIn, Instagram, Facebook, YouTube, if I can get 1,000 people in reach, I can put my head on the pillow at night and say, okay, I helped 1,000 people. Now, does that mean that 1,000 people are actually reaching out to me and saying, okay, I want you to help me make a little bit more money and find a secondary income and pay for my retirement and get my kids through college and get out of debt and buy this great car and, live the life that I want? No, but I think I am sharing value that is truly helping people.
You are. Absolutely. And think about this. Consider this. How many of those people, of those 1,000 people in your example, how many of those is it where you're planting a seed and get someone to think about and consider an idea differently, or inspire someone, hey, I want to learn more about investing. And then maybe it takes them a year to get around to it, or a year before they call you because they weren't sure. And that's okay. You're setting off a chain reaction. You're planting the seed and making an impact. And that's a wonderful thing. It's a wonderful thing. And that's part of the energy. One objective I have is I always want to leave each person I come in contact with, I want to leave them better off than they were before they met me.
Yeah.
And I love that.
Yeah.
And maybe we do business together in some way, some maybe not. That's okay. I want to share ideas. I want to educate others
Mhm.
and inspire people to pursue their financial literacy and pursue the self-education that's required.
Why do you think the financial services industry? So I've been in the financial services industry since I was 23 years old, 27 years. And when I first got into the industry, it was only tell people what they need to know. Don't tell them the whole thing. Keep them coming back, because if you share too much up front, they don't need you.
It's a scarcity mindset.
Yeah. And
It is.
I'm not there. I'm not there at all. I don't think there's a scarcity with money. I don't think there's a scarcity with information.
Yeah.
Maybe a scarcity with land, but as your example of the single story commercial property is now 4.
Yeah.
So
It's
as long as
like
we-
air, right?
yeah, as long as
There's
we can
enough
keep those-
air. We don't have to put up barriers and walls around air and that there's enough for everyone. There's
do a little bit of the woo-woo. Don't you think we've created that divide of financial literacy? Don't you think that we've done that on our own? And that's why so many people are suffering financially. 57% of Americans can't find $1,000. They don't have anybody that they can call to borrow $1,000.
yeah. I don't think so. I think that people do what they'll do, right? We've all heard the different stories and scenarios of people winning multi-millions in lottery and they don't know how to handle money. And then within 2 years, they're completely lost everything. We see it all the time with athletes. They if they're not prepared to handle making millions and millions of dollars a year in a career that it's not going to last very long, they have the opportunity to get themselves set up in a way that's sustainable for their whole lives. But we see others that don't make good decisions and they just blow all their money. And then after a few years, maybe they get injured or they retire and they're really not in a good financial situation. A lot of it comes down to the choices and decisions that we make.
Why do you think Shaquille O'Neal is so good at not only taking $1 and turning it into 10, literally.
Mhm.
And then, so that's Shaquille O'Neal. And then you go to Bo Jackson. Bo Jackson had an own occupation disability policy when he blew out his hip. There's a young golfer who got injured. He had a huge disability policy, own occupation disability policy. You have people like that. And that's the reason that he's not coming back and playing golf, because his disability policy is guaranteeing him a lifestyle that he basically took premium dollars and transferred that risk to Berkshire Hathaway. And then he is getting a return on that money because he suffered a career-ending injury. But then you have people like this young man last night. I'm sitting here in San Antonio, Texas. This young man last night that got picked in he was the number 1 draft pick last night. And he got instantly a bunch of money. What is going to separate him from basically the losers to the giants of now equity and finance, like the Shaquille O'Neals of the world?
Yeah.
Is it the people around him?
Absolutely.
Is it his ethics that he was disciplined enough?
It's all of those, all of
Yeah.
the above. The
See,
people around, the people you surround yourself with is
Yeah.
huge. Does he have good guides, good advisors,
Yeah.
trainers, and coaches?
Mhm.
Right, the athletes. That's who they spend their days with.
Right.
What kind of education did they have and background with handling money? These are things that are not taught in school, and
Yeah.
so it comes from having mentors in your life, having the
Okay,
right
so let's
people.
so let's
Yeah.
dive a little deeper. It's still not taught in school. Okay.
Mhm.
And now we see what's being taught or being allowed in public schools, and
Yeah.
we'll get into it later. Why do you think children are not being taught financial literacy in school?
This boggles my mind.
Mhm.
Um,
You-
People
and I've
graduate
got my
from high
tinfoil
school.
cap on now. Okay, I've got my tinfoil cap on. If we keep them dumb, they will do things to make us money, not you and me, but the powers that be.
Yeah, isn't that how public education came about? Was
Mhm.
to train all the workers needed during the Industrial Revolution to be factory workers and follow the system and follow the rules and all of that. And so that's an interesting question. But what I what pains me to see is people graduate from high school and they don't understand how a loan works,
Yeah.
how compound interest works, right? We have Albert Einstein, one of the greatest physicists, who said that the eighth wonder of the world is compound interest.
That's exactly
And
what I
you're either paying it. If you don't understand it, you're paying it. And if you do understand it, you're receiving it.
Mhm.
So back to the loan example,
Yeah.
high school graduates, they don't understand how a loan works. And then they're 18, they get out into the world, they're working, and they go buy a car. They're buying their first car. And what happens? They walk into a dealer, and the first thing the salesperson says is, how much of a payment do you want to make? And so they sell them on a payment, not taking into account how much is the total cost of the car or what the interest rate is or any of that. All they focus on is, how much of a monthly payment do you want? And that's it. And that's the worst way to approach a purchase like that. But unfortunately, that's how it is. I see that all the time. This happens with large purchases, and it's terrible. It's terrible when I'm in that seat where I'm shopping for something. I see it. They ask me, "Oh, how much of a payment do you want?" No, and I'm like, "No. How much is the thing if I'm paying for it all cash?"
You figure
And
out.
then we go from that's where we start. And then we go from there, and then we can look at different finance options if eh, but approach it as understanding all the pieces of a loan, how it works, the
Right.
loan balance, the
And
interest rate, the
credit. Right.
amortization, credit.
And
Yeah.
I think what you're saying is understand credit and how credit is derived and how you get credit, which equals liquidity that you never get to see. It creates liquidity for the dealer in order to sell you that car. And isn't that how we got into the 2008 financial crisis, which was a credit crisis, not a crisis?
Yeah, it was. It
So
was.
you had these ridiculous appraisals because of comps for a particular home, because these banks were saying, yeah, we'll give you $500,000 for that $300,000 home.
Yeah.
I mean,
And
isn't that
you don't
how
have
we're
to document
created?
your income. You can just
Yeah.
tell us what it is.
Yeah, you could fog a mirror and get a loan. It was incredible.
Yeah.
Um, well, I mean, I know it's not you and me for don't you think that, I mean, and I don't, well, I'll just say it. Don't you think that banks have created financial illiteracy? I mean, when it comes to money in general, that they don't know where money comes from and they keep people in the dark.
I think that what's great now is we have access to all the information in a way we never had before. When I was growing up, it was before the time of the internet and YouTube and having all of this information available at our fingertips. But now, if you want to learn how a loan works, you can go right on YouTube and watch a 10-minute video and you'll have a pretty good understanding of it. But no one's going to hold your hand to go do that. You have to set the intention and say, I want to understand this. And then you do it. So it's a good part of it's self-education. And this is important for each of us to understand how this works. Because if you don't, you're going to walk into a dealer and get sold on a payment. And it's the worst thing.
And always be in a position, maybe not always, but most oftentimes than not, that particular human is going to be in that position perpetually.
Yes.
They are just going to keep renewing and renewing. And then the only thing that helps them, the only thing that they believe helps them is inflation. But if their wages are not being helped by inflation, they're always going to be behind the 8 ball.
Yeah.
Always.
Never getting ahead and just getting in debt.
Yep. We're going a little long here, but I wanted to reiterate what we had talked about in our deleted session about basically being, the person that you need to be in order to help as many people. You have to give away literally, and there's been actually studies on this, and there's a guy in Australia named Kerwin Ray. He talks about give 96% of your insight and your experience away. Keep the 4%, and that's the people that want the 4%. That's how you're going to get your own wealth, is helping the people who really want to see a change in their lives. Do you find with discipline that it can be learned, or do you think people just kind of just give it up, that they can't really learn how to be disciplined with a dollar?
Discipline is a skill. It's just like exercise and fitness. It's available to anyone. You just have to decide that you want it and work at it.
Yeah.
It's about habits, getting good at habits, making small steps with consistency every day. That's discipline. And some people are better at it than others, but it's something we can all improve on. And all it takes is you setting the intention that that's something you want to focus your efforts and energy on, and then do it and start small. Don't take on these big goals all at once. Start small. If you want to here's a great example. If you want to pursue fitness, let's say you decide, I want to run a marathon. You never ran before, never did any training. Well, you're not going to just put your shoes on and go practice running the marathon day one. Maybe you start out, maybe you're a sedentary person, not in good fitness. Start out by taking a walk around the block and doing it every day.
Yeah.
Even when the weather's bad, even when it's snowing out, do it every day. And then over time, that's going to grow and evolve. Pretty soon you'll do a jog and you'll do a mile and build and build and build. And maybe you'll get around other people that want to train for a marathon together. Now you're in a group setting, right? And you have some mentors and people help each other. takes you a little further. And so this is something that you can apply to anything in life, anything you want to grow and evolve as a skill.
But that's,
All it takes is for you to dedicate the time and energy to it.
yeah. And that's compounding. That's
Yeah,
layering, one activity over another, and the same can go, with money.
absolutely.
Uh,
With money.
just
If
just
you're
with just with savings and then getting out of debt at the same time. You can save money and get out of debt at the same time. I'm not a big, obviously I'm not a big Ramsey fan, but I understand what he's doing. I understand his mission and purpose.
Yeah.
I understand his honoring God in not having debt. But
Mhm.
I also believe that debt doesn't necessarily have to be a horrible thing as long as it's manageable within that personal economy, that you're not
Exactly.
giving up wealth.
Yeah, absolutely. I'll refer to one of the big concepts in the book Rich Dad, Poor Dad by Robert Kiyosaki and Sharon Lecter, right? They teach in that book the concept of there's good debt and there's bad debt. What's bad debt? Bad debt might be credit card debt where you go and spend your money on a whole bunch of doodads that sit in your closet and depreciate in value over time. Well, what about good debt? Good debt is debt that you take on to purchase an asset that generates income for you. And that income covers the debt service.
Yeah.
So the income pays down the debt and pays it off eventually. This is used in business all of the time. Right? Manufacturing, companies need to spend money for materials and manufacturing, and they incur debt, but then they know that a couple of months down the road, they'll have their finished products and they sell all of that and then pay down the debt and make some profit too if they did things well. That's an example of good debt. So good debt, if you're buying a rental property and you put financing in place, the tenant rents the property out, pays down the mortgage. That's an example of good debt.
Yeah.
And so, what about education? You're taking on college loans. Well, if you get a degree that's going to let you have a high-paying job with good wages, then you'll make that income and then pay down the debt. And that's good. That's an investment in yourself. So these are all different examples. I completely agree with you. I'm not a fan of the no debt at all, but be smart about it
Yeah.
and take into account these concepts of good debt and bad debt
Yeah.
and pay attention and be mindful and purposeful about the way you use it.
Yeah. Well, Fred, as we mentioned before, I'm contemplating, I'm dreaming. I've not written it down. I guess I'm putting it out into the universe, but I haven't written it down. I am looking forward to building some sort of a summit or a mastermind or a conference to where people can come and get educated very quickly.
And be
Because
around
honestly,
like-minded individuals.
right.
That's one of the
but I
best
have,
parts about attending events like
right.
that
And
is,
the energy compounds because, and I'll tell
yeah,
you this, the online courses, oh, I hate them. I think I see one and I'm like, okay, I want to learn about this. Finish a course. Or finish a course. And I pay thousands of dollars for these courses. The only way that I got anywhere in scaling up my business was not reading Tony Robbins or Brian Tracy or Jim Rohn. It was actually sitting there and going to their conferences and then actually hiring Tony Robbins coaches to hiring and then paying them on a monthly basis to coach me.
mm,
The individual alone, that's why school works so well, is because you're all getting the same energy and you're all kind of moving in the same kind of herd-like mentality. But you can move in a herd-like mentality as long as you're moving towards something greater than yourself and trying to better yourself. So I can see me doing something super small here in Texas, probably in October when it's the perfect time to be here in Texas. So I hope you'll consider, doing like a little breakout session or a workshop for us or something like that.
I'd love to. That would be
Yeah.
wonderful.
Yeah.
I
Good.
hear there's good barbecue
Yes.
to enjoy
We
in
have
Texas.
good everything. We have good everything. We have no income tax. Everybody's friendly. Don't believe anything that you hear on any of those networks or what you see on the fake news, because this is a great place.
Yeah,
We're actually a
experience for
great-
yourself.
Right. We're actually a great country. We just haven't pulled the trigger on that yet.
That's great.
I think-
I think that's a great idea, what you're putting together and the vision you have. And I'd love to participate. Thank you.
Excellent. Well, thank you, Fred. Thank you. Thank you for today.